In a world transformed by AI, one multi-trillion-dollar industry operates on technology that is decades old: mortgage lending. The reason isn't just caution. A significant portion of many lenders' IT budgets is spent just maintaining these ancient, legacy systems. This isn't just a cost, it's a cage. 56% of lenders cite integrating new tools with this old infrastructure as their biggest challenge. And it's not just the technology that's resistant, it's the people, who fear AI will replace the critical human touch in a complex transaction. So we'll dissect why this industry is frozen, reveal the massive rewards for those who break the ice, and pinpoint your biggest opportunity right now. Beyond the old tech, what are the practical barriers causing this multi-decade delay? It comes down to three core factors: money, data, and timing. First, the sheer cost of implementing new AI systems is a massive deterrent for firms of all sizes. Second, AI is only as good as its data. The mortgage industry runs on inconsistent, unstructured information, which poisons AI models. Finally, timing is never right. In a boom, they are too busy to upgrade. In a bust, they are cutting costs, not making huge investments. But all these issues circle back to the legacy system trap. It's not just one problem, it's a tangled web of outdated code and manual workarounds. Remember that IT budget figure? That's not just keeping the lights on, that is actively preventing innovation. It is a moat that protects the status quo. But the paralysis isn't just about old tech and money, it's about a wall of fear. So, what are regulators and executives really afraid of when it comes to AI? A primary fear is the black box. In an industry that legally requires clear reasons for every decision, an AI that says, "Trust me," is a non-starter. But the biggest fear, with the most severe consequences, is algorithmic bias. This is the risk that an AI will learn and perpetuate existing discrimination. It's been dubbed digital redlining, and it's a massive legal and ethical minefield. Regulators are heavily scrutinizing AI for this very reason. So you have fears over data security with sensitive financial info, compounded by a constantly shifting landscape of federal and state AI regulations. With a landscape this treacherous, it begs the question: why would anyone even attempt to bring AI into mortgages? The prize for success is transformative, because AI can slash loan processing times by up to 50% and operational costs by 30 to 50%. That isn't a small improvement, it's a fundamental business change. AI systems can detect suspicious patterns in real time, improving fraud detection capabilities and preventing millions in losses. They analyze vastly more data than a human can, leading to more accurate underwriting and default rates that are up to 25% lower. And for the borrower, it means 24/7 support and faster answers, meeting the on-demand expectations set by every other industry. The most powerful change? AI doesn't replace loan officers, it superpowers them, automating paperwork so they can manage a much higher capacity. So if the rewards are this massive, why have so many early AI projects in mortgage quietly failed? It's because they fall into the automation paradox. Lenders expect a generic, off-the-shelf AI to deliver instant, full automation. When it fails, it creates new bottlenecks and disappointment sets in. This highlights the distinction between generic AI and vertical AI. A generic AI knows nothing about RESPA compliance or underwriting guidelines. Vertical AI is purpose-built for a specific industry. It's trained on relevant data and designed around its specific workflows and regulations. This is the central friction point. The industry is paralyzed by fear and stuck with legacy tech, while the only solutions offered are generic tools that don't work. This is where the real opportunity emerges. The industry's greatest fear, bias, and its greatest failure, generic AI, are actually pointing to the exact same solution. Recall the crippling cost of legacy systems. The business case also centers on the massive savings from replacing outdated tech with a single, intelligent, vertical AI platform. Remember the digital redlining fear. A properly designed vertical AI can counteract historical biases by using alternative data to identify creditworthy people, MS. So the opportunity isn't just adopting AI, it's about building the right AI, a vertical solution that reduces costs, expands the market, and actively promotes fairness. The mortgage industry's slow adoption of AI isn't a sign of a failed market. It's the clearest possible signal of a massive competitive advantage waiting to be claimed. The lender of the near future will not be the one with the most branches, but the one with the smartest platform. They will be faster, more accurate, and ultimately fairer. For investors and entrepreneurs, this is one of the last great, underserved markets for vertical AI. For mortgage professionals, this is the tool to dominate competition. The mortgage industry is the last frontier for this wave of AI disruption. The question isn't if it will be transformed, but who will be the ones to do it.